All right, welcome to the CIO Brief. This is Brad Johnson with Evergreen Capital, and we're going to talk today a little bit about what happened this week with the Fed. I normally don't like talking about the Fed. However, it is fairly symbolic for people that have been waiting to refinance their home, refinance their real estate property, their commercial project that have felt a little bit stuck in high rates. And so we're going to touch on it briefly today because this week the Fed and Jerome Powell reduced the Fed interest rate down to a range of 4 to 4.25. This is a good positive move in the right direction, I think. We certainly need to have more movement in financial markets where people have high interest rate loans and feel like they're making these large payments because it's tied to this variable rate that is determined by the Fed, the base rate really. And you have a ton of people that are kind of trapped in their mortgage, in their homes, where they feel like they can't go out and buy a new house because they have such a low rate on their current property. And so that is limiting the movement of people in society, and that is not as good for the economy as having a free-flowing marketplace. And so I think it's a step in the right direction. The Fed was a little bit behind on adding liquidity to the market when COVID happened. Then they put way too much in, and they were too late to take their foot off the gas. And now I think they've overcorrected, and they're waiting too long to ease. But they are worried about tariffs. They're worried about runaway inflation, even though the data seems to suggest that we do not have runaway inflation and it continues to be stable. But they're also looking at the job market now, and the job market is certainly softening, it appears. So anyways, I think it's a positive, emotional week for the marketplace and for investors who have kind of been waiting for this to happen. I mean, a quarter point is certainly not that much. And the bond markets are really loose from what the Fed is doing anyway. The bond market's going to do what the bond market's going to do at this point, regardless of what the Fed says, at least in the 10-year and longer duration bonds. Like longer term bonds are more based on market dynamics and whether or not people want to buy U.S. debt versus the floor that the Fed is setting, which is more tied towards short-term yields, which is why the short-term yields, fell this week substantially. And the longer-term yields, actually, some of them went up a little bit. Like the 10-year went from 4 to 4.2 this week, even though the Fed dropped interest rates. So anyways, long story short, positive news overall, but something that we're aware of and we track and keep tabs on, but we certainly don't make any moves, any investment, big changes in our portfolios or our recommendations to our clients based on what the Fed is doing in any given quarter. So anyways, let's pull up some slides on this, on the market. All right, so here's the Fed funds rate graphed. As you could see, it's been a fun and wild ride the last few decades. And so here we are here at 4 roughly, and these fun dots, colorful dots here looking forward are the predictions from various sources, either from the Fed itself or the stock market's expectations. And you can see they're making their best guess, but nobody actually knows what's going to happen. How I tend to think about this is we don't make any predictions on where interest rates are going. However, it is useful to kind of think about probabilities, and it certainly doesn't seem like we're heading down here, right? This would feel like a 3 standard deviation type of move where we would be back at 0% interest rates. And that rough guess is just based on how much debt we have as a country, our budget, which is by no means balanced, and just overall appetite for bonds given the bout of inflation that we've had. So we're probably not going back to 0%. Certainly nobody thinks that as well. And it's probably unlikely that we're going up to, 7, 8%, even though all bets are off. We have no idea. But that does also feel like an outlier, 2, 3, 5% type of moves. Those are the extremes. Seems unlikely that we're going around there. So we're in a higher for longer type of environment, and therefore we need to invest accordingly, right? We're probably not going to be able to get 0% interest rates and see the tech stocks, continue higher to 50 multiples like they did in 2022. So we adjust accordingly. We still like debt investments because they're offering, higher yields and probably will be for the foreseeable future. But we don't like really short-term bonds right now. We've been spoiled the last couple of years with being able to put our money into 5% type of returning risk-free rates on short-term bonds. But I think that party is winding down. So as the Fed has been signaling that they're going to be cutting, and now that they are cutting after about a year pause, the short-term rates and the short-term savings yields, right, that you're getting on safe cash has been declining. And so, a 3% type of interest rates, even if it's high threes, is a lot less interesting than five, frankly, to me, especially if we're going to be in a higher interest rate or, sorry, a higher inflationary environment where that inflation would be eroding that 3% type of savings interest rate. Then you're kind of just breaking even and treading water. We like, still making risk investments in both debt and equity, but we have to pick our spots to make sure we're not overpaying, of course. So anyways, that's just how we think about, the the path of interest rates. While we have no idea where it's going, this is where the smart money seems to think it's going, but we just try to think about planning for the 90% outcome type of range as opposed to thinking at the extremes, which do feel unlikely. So by no means does this cause us to make any trades, but it is in the back of our mind in terms of where we think the overall gravity of the market, which is the Fed funds rate and the 10-year rate. So those are kind of anchors to the market. And so we think about our investments with that in the back of our mind. And this slide here is on the labor market. And this is part of the reason why the Fed is easing, is because we're seeing a big slowdown here, this steep decline you see in payroll gains over the last couple of years has been slowly degrading. And so we're seeing employment slow down. That the new hiring jobs has slowed, and the labor force, thankfully, has been fairly stable in terms of participation. So the unemployment rates are not spiking. That might be a function of the stricter immigration laws that we now have as a country. But this is a big warning sign that the Fed is really prioritizing in cutting rates. And so jobs are certainly a critical aspect of the economy. We want to be watching payroll gains just to make sure that we're not quarter over quarter losing a ton of jobs. It will be interesting to see how AI ends up affecting payroll gains over the next few years. But it's such an important aspect of the economy. It's something that we keep our eye on. But it's certainly one of the major catalysts of why the Fed is deciding it's okay to start cutting, is because they're seeing softness in the labor markets. Then I wanted to share this slide because I think it's interesting, just looking historically back at what the stock market's done when there is a first cut in rates from the Fed. And this is with the caveat that in a non-recessionary environment. So as of now, we don't have a recession. We're about 12 months from the first cut. And so it's just instructive. None of this data is science. We can't go out and bet the farm that the markets are going to react like they have in the past, but it's just interesting nonetheless to show how stocks have done on the left here. So you have 1995 where they just go on a rip, and then you've had the couple of years where they haven't done so well. And then on bonds on the right-hand side have historically done well in all of those periods after that first cut. Which makes sense. Bond interest rates declining, that means the price is increasing. That's just how bonds work. It's not to say that it's going to happen the same way this time. We're in a rather unique environment with 37 trillion of US debt, but that's the historical pathway, and all bets are off if we end up having a recession, of course. But this is what it's looked like in the past, which I just think is an interesting story and data point. All right, last slide of today, we have the historical valuation dispersion. And that's a fancy way of saying the distance in valuations between the most expensive stocks in the stock market and the least expensive stocks in the stock market. So in other words, this gray shaded area, this is the distance between the NVIDIAs of the world, the Palantirs of the world, to probably some lowly utility company that is trading at 8 times earnings. So this dispersion is pretty wide, right? You could just kind of see how it was tighter in here and it's now gapping out. Part of this is just a function of how great some of these technology companies are and how profitable they are and the unreal growth that they've been achieving. And some of it is probably a little bit of an AI bubble. There's no absolute here. It's probably some combination of both of those things. It's some combination of a lot of things, but those are certainly two of the more important ones. We have people who are very excited about these best technology companies in the world, and they could care less with some older industry boring companies that just kind of deliver some cash and don't grow at all. So anyways, I thought this was an interesting slide to share. It's something that we want to keep track of. It leads to some opportunities that people can find in the market. If you do like to kind of have fun with the side investment account where you pick stocks and you like to just pick a few winners, we think that's fine. We want majority of our clients' money just having access or an exposure to the overall market via an index type of investment. I personally like to make some fun picks here and there with what I think is the highest quality companies that have the brightest future, but it's certainly not my main exposure to the overall equity markets. So yeah, this is a good data point, and just it's always great to track the median PE, which currently is at 19.4. Obviously, it's much higher at the top end, touching in here around, we got 30 for the 80th percentile valuation of stocks at the higher end of the market. All right. Now we're going to switch over to an investment spotlight. And this is more of an investment strategy spotlight based on new regulation from the big, beautiful bill, Tax Act of July. And one of the interesting parts of that bill was the changes they made to opportunity zones. And so I'm calling this Opportunity Zone 2.0, right? We had the first version, which is pretty innovative, where the governors of the states of our country could select areas in their state that were designated these opportunity zones. And that gave investors and developers tax benefits to go ahead and improve those areas. So come in with a lot of money and build affordable housing, maybe build some new distribution centers. It seems like the majority of it was more multifamily apartments, and it has to be a development. I mean, technically, I guess it could be partially maybe a half occupied property, but you have to double the basis of the land improvement. So in other words, you have to throw a lot of money at an existing piece of property, basically to make it a brand new type of property in order to qualify for this tax treatment. And just to remind you what OZ 1.0 looked like, you got a 5-year deferral of your capital gain. So you could sell your NVIDIA stock, right? And instead of paying 37% in capital gains taxes in California, you could defer that for 5 years, was the original plan when the first year the OZ 1.0 came out. And then you could, as long as you held that asset for 10 years, you could enjoy zero taxes on the gains from that new investment. So it was a nice program, right? You got a 5-year deferral of the original capital gains tax, and then you got the added benefit of the new investment not being taxed after 10 years. And so if I think about this correctly, I think it was designated kind of in the 2019 area. So you've had about 5-6 years until 1.0 stopped, and everybody was trying to figure out, well, what's going to happen after 2026? And well, they came out with 2.0. And so instead of just, that winding down of that initial benefit, that 5-year deferral, which ended up happening in 1.0. In other words, if you made an investment in OZ property in 2024, you really only had 2 years of capital gains deferral because the program was ending. But now they've come up with the new program where it's on rolling 5 years. So if you make a new investment starting in 2027, that's when this new program kicks in, then you will have 5 years till 2032 before you have to pay that capital gains tax. And then, of course, you get that same 10-year benefit of that new investment. If you wait 10 years, you don't pay any capital gains tax on that new investment, that likely development. Perhaps it's, once again, apartments or industrial or even a hotel. I've seen some of those. And the third benefit, which is underappreciated, I don't think people fully realize this benefit, is that you get also the depreciation of this new investment along the way as this building is being constructed or these new improvements are being added to a property. That creates bonus depreciation that you can use over that 10 years to either offset cash flow from the property or offset other gains that you might have. And when the 10 years expires, when you go sell this big, beautiful building in an opportunity zone, when the sponsor sells it, you're probably not the development person, right? Usually you're partnering with somebody. But when they go to sell it, there's no, once again, capital gains on that investment, and there's no depreciation recapture. In other words, you don't have to pay back the tax that you were deferring through depreciation along the way. So that's kind of the trifecta of sweet tax breaks is Opportunity Zone 2.0. And it's a great for the country too. It's great to see the progress and the new buildings that have been built and the new housing units that have created wonderful homes for affordable families that need affordable housing in this country in areas that probably wouldn't have seen that investment if this program didn't exist. And they're not all remote, crazy markets that are in the middle of the nowhere. There are certainly lots of those zones that you would never want to invest in, but there's plenty of them that are just kind of on the edges of larger areas or MSAs that are seeing actually substantial growth. And so the key with any of the tax strategies that we're going to share, in some of these episodes, and we recommend to our clients, is the key is always pairing the tax strategy with actual great investment, right? You don't let the tax tail wag the dog, so to speak. And so you got to make sure you're going into a good property here in this program, and you're going into a good investment anytime you're thinking about tax. You got to put the red flag up, like, I am thinking about tax, so I am probably biased with what investments I am willing to do. So if you know you have that bias going into it, you might prevent yourself from making a tax-driven investment. And with opportunity zones, I think some people might have gone to markets they wouldn't have otherwise gone to ever with an investment, but they were maybe blinded by the tax benefit. You got to make sure you combine these two things together, right? The great tax benefits with the great investment. But assuming you can do that, I think this is a home run project, a home run proposal that the government has actually come up with. It's one of the few ones where you're like, yes, this was a good, this was a good thing they did. Social Security, that safety net, as it was originally planned, great program they came up with for the citizens of our country. They might have let that program go a little crazy by robbing it the last, 50 years, and now it's not exactly solvent. But the initial idea was certainly a great idea. And I think opportunity zones are in that same category. And we're excited to see what new investments and new sponsors, the deals that they come up with over the next couple of years. Because once again, I think it's about a year before you want to start even making an investment to really get this new benefit of that 5-year deferral. But something to keep in mind, and we'll certainly be sharing some deals that we like with our clients if they need those tax benefits that we're talking about and think an OZ 2.0 is a great idea for them. All right, that's the end of the investment spotlight of this week's episode of the CIO Report. Why don't we end up with a couple questions here as we're winding down on a Friday. We maybe make this one a little bit shorter than usual. Let's bring in our trusty associate, Jesse. Jesse's with us.
Yeah.
All right. Do we have questions from you and or anybody else that might want to dive into something I touched on?
Yeah, you killed it. There's a couple questions that I have jotted down here. Let's just go right back to those opportunity zones since you were just touching on them. So rapid fire. Who are ideal candidates to utilize Opportunity Zone 2.0?
Yeah, it's somebody with gains, right, that has sold either a business or stock, or even maybe they own an apartment building and they had a lot of depreciation that they used. So the value of the property, they've depreciated the asset. And so they're going to owe that money when they go to sell it, right? So they have to pay depreciation recapture, right? And they're going to have to pay capital gains. So that's a big tax bill. They can take the capital gains portion of that bill and defer it by just taking that money that they earn in profit, making an investment in Opportunity Zone. They don't have to pay the taxes for 5 years. And of course, they get the benefits of that new investment over 10 years by not having to pay tax when that investment sells. So yeah, it works for just about anybody that has a large capital gain that likes real estate investments. It's not the only type of investment that works for OZ Fund. I've actually seen a couple of private equity type of deals where business existed in an opportunity zone. That is very interesting. I think you just have to, obviously be careful there because real estate tends to be a little bit more stable with the returns versus a business. But I think it's a unique way to use the program. We just don't see as many great deals in that space as we do in high quality real estate assets. Oftentimes a lot of these people that are selling, the property that generates this gain are real estate people. They're just more comfortable than investing in a real estate project on the back end.
Okay. Is there like a minimum number in capital gains that our listeners are going to want to be able to see before they can take advantage of this?
It really is kind of driven by the type of sponsors that are high quality, that invest in their own deals, that have a great track record, That's more of the gating function, right? You wouldn't want to do it
Okay.
for $25,000, right? So $100,000 tends to be kind of the minimum check size that one of these higher quality groups will accept. And also, if you think about the taxes on 100,000, especially if you live in California, you're in a high tax bracket. Well, that's $37,000 that you would be saving. So not insignificant. That's probably the lowest end that you'd want to do with this.
Okay. That makes sense. The next question was going to be, is there anyone that you would say is not qualified?
I'll touch on that. A lot of these are developments. So if this is your only real estate investment, it's probably not a great idea, right? Because you want to be able to if you're investing in an individual deal, you want to be able to make your own little portfolio of deals, right? So I like it when somebody says, okay, I'm going to invest 100,000 in this one, 100, right? And puts at least $500,000 to work.
Yeah.
Because then if one project doesn't work out that well, then it's not like their entire real estate portfolio goes to zero. So yeah, I would highly recommend that people do this in a diversified way, especially because they're investing in a development, which is just higher risk to begin with. You got construction risk, you got execution risk, you got lease up risk. So it's just, it's a different risk profile than an existing asset that's already there and full.
Okay. So it sounds like, we won't really have the opportunity to access these deals for the next couple of years because that's when the program begins, 2027, right?
Yeah, it's when it resets where you can get that full 5-year deferral. If somebody made an investment today in an OZ deal, they would only get 1 year of deferral. So
Okay.
that's less compelling, right? Unless you have a unique circumstance where it's like, I really don't want to pay the taxes this year. I have a new bonus coming in next year that's going to enable me to make that payment, right? Then maybe you do it, right? But that's kind of a small use case.
Okay. Okay. Cool. Makes sense.
All right. Well, thanks everybody. Appreciate you listening, tuning in, and have a great week. Bye.